In this session we going to learn about income under the head of salaries. Section 15 to Section 17. Before that, if you're watching my video without subscribing to my channel, do subscribe and like the video. It motivates us to upload more. This channel runs on without monetization. We don't earn any income. My only purpose, I opened this channel to share knowledge among students to score good marks. All I need is your support, so subscribe and like my video. House rent allowance. HRA is a special allowance specifically granted to an employee by his employer towards payment of rent for residence of the employee. HRA granted to an employee is exempt to the extent of least of the following, in case such assessee exercises the option of shifting out of the default tax regime provided under Section 115 BAC, 1A. Let's see the calculations. First scenario. Other cities. Step 1. House rent allowance actually received for the relevant period. Step 2. Rent paid minus 10% of salary for the relevant period. Step 3. 40% of salary for the relevant period. Second scenario. Metro cities. Delhi, Kolkata, Mumbai, Chennai. Step 1. House rent allowance actually received for the relevant period. Step 2. Rent paid minus 10% of salary for the relevant period. Step 3. 50% of salary for the relevant period. Here salary should be taken while calculating. Salary for this purpose means basic salary, dearness allowance forming part, if provided in terms of employment, and commission as a fixed percentage of turnover. Salary means salary on due basis. Relevant period means the period during which the said accommodation was occupied by the assessee during the previous year. If the employee receives HRA but does not incur any expenditure of rent on residential accommodation, then HRA received is fully taxable. Exemption is not available to an assessee who lives in his own house. The exemption shall be calculated on the basis of where the accommodation is situated. If place of employment, rent, house rent allowance, salary etc. is the same for the whole year, then exemption shall be calculated for the whole year. If there is a change in place, change in rent paid, change in house rent allowance or change in basic salary structure during the previous year, then it shall be calculated on monthly or periodic basis. Exemption should be calculated in respect of the period during which rental accommodation is occupied by the employee during the previous year. Exemption under Section 10 subsection 13A would be available to an assessee only if he exercises the option of shifting out of the default tax regime provided under Section 115 BAC, 1A. It is not available under the default tax regime under Section 115 BAC. Provident Fund. Provident Fund scheme is a scheme intended to give substantial benefits to an employee at the time of his retirement. Under this scheme, a specified sum is deducted from the salary of the employee each month or at regular intervals as his contribution towards the fund. The employer also generally contributes the same amount out of his pocket to the fund. The contributions of the employer and the employee are invested in approved securities. Interest earned thereon is also credited to the account of the employee. Thus, the credit balance in a provident fund account of an employee consists of the following: employee's contribution, interest on employee's contribution, employer's contribution, interest on employer's contribution. The accumulated balance is paid to the employee at the time of his retirement or resignation. In the case of death of the employee, the same is paid to his legal heirs. The Provident Fund represents an important source of small savings available to the government. Hence, the Income Tax Act gives certain deductions on savings in a Provident Fund account. Recognized Provident Fund, RPF. Recognized Provident Fund means a provident fund recognized by the Commissioner of Income Tax for the purposes of income tax. It is governed by Part A of Schedule 4 to the Income Tax Act. This schedule contains various rules regarding the following: recognition of the fund, employees and employers' contribution to the fund, treatment of accumulated balance, etc. A fund constituted under the Employees' Provident Fund and Miscellaneous Provisions Act will also be a recognized provident fund. Unrecognized Provident Fund, URPF. A fund not recognized by the Commissioner of Income Taxes. Unrecognized Provident Fund. Statutory Provident Fund, SPF. The SPF is governed by Provident Funds Act. It applies to employees of government, railways, semi-government institutions, local bodies, universities, and all recognized educational institutions. Public Provident Fund, PPF. Public Provident Fund is operated under the Public Provident Fund Act. A membership of the fund is open to every individual, though it is ideally suited to self-employed people. A salaried employee may also contribute to PPF in addition to the fund operated by his employer. An individual may contribute to the fund on his own behalf as also on behalf of a minor of whom he is the guardian. For getting a deduction under Section 80C, a member is required to contribute to the PPF a minimum of Rs. 500 in a year. The maximum amount that may qualify for deduction on this account is Rs. 1,50,000. As per PPF rules, a member of PPF may deposit his contribution in as many installments in multiples of Rs. 500 as is convenient to him. The amount of contribution may be paid at any of the offices or branch offices of the State Bank of India or its subsidiaries and specified branches of banks or any post office. The tax treatment is given in the slide for your reference. During the employment period. First we going to look about recognized provident fund. Employers. Contribution in excess of 12% of salary is taxable as salary under Section 17(1). Employees. Contribution eligible for deduction under Section 80C, wherein employee exercises the option of shifting out of the default tax regime provided under Section 115 BAC, 1A. Interest credited on employers' contribution amount in excess of 9.5% per annum is taxable as salary under Section 17(1). Interest credited on employees' contribution amount in excess of 9.5% per annum is taxable as salary under Section 17(1). Interest credited on contribution by such person or employee amount withdrawn on retirement or termination exempt under Section 10(12). Subject to certain conditions. I have given detailed explanation in the next slide, so don't skip the video. Next. Unrecognized Provident Fund. Employers' contribution not taxable at the time of contribution. Employees' contribution not eligible for deduction. Interest credited on employers' contribution not taxable at the time of credit of interest. Interest credited on employees' contribution not taxable at the time of credit of interest amount withdrawn on retirement or termination. Employees' contribution is not taxable. Interest on employees' contribution is taxable under Income from other sources, employers, contribution, and interest thereon is salary. Next one. Statutory Provident Fund. Employers. Contribution. Fully exempt. Employees. Contribution. Eligible for deduction under Section 80C, wherein employee exercises the option of shifting out of the default tax regime provided under Section 115 BAC, 1A. Interest credited on employers. Contribution fully exempt. Interest credited on employees. Contribution exempt up to certain limit of contribution amount withdrawn on retirement or termination. Exempt under Section 10, 11. Next one. Public Provident Fund. Employers. Contribution. Not applicable. As there is only assessees. Own contribution. Employees. Contribution. Eligible for deduction under Section 80C, wherein employee exercises the option of shifting out of the default tax regime provided under Section 115 BAC, 1A. Interest credited on employers. Contribution not applicable. Interest credited on employees. Contribution fully exempt. Amount withdrawn on retirement or termination. Fully exempt under Section 10, 11. Carefully listen to the upcoming points to clearly understand this table. Salary for this purpose means basic salary and dearness allowance, if provided in the terms of employment for retirement benefits and commission as a percentage of turnover. As per Section 10 subsection 11, any payment from a Provident Fund, PF, to which Provident Fund Act, applies, or from Public Provident Fund would be exempt. Accumulated balance due and becoming payable to an employee participating in a recognized Provident Fund, RPF, would be exempt under Section 10 subsection 12. However, the exemption under Section 10 subsection 11, or 10 subsection 12, would not be available in respect of income by way of interest accrued during the previous year to the extent it relates to the amount or the aggregate of amounts of contribution made by that person/employee exceeding Rs. 2,50,000 in any previous year. In that fund, on or after April 1, 2021. If the contribution by such person/employee is in a fund in which there is no employer's contribution, then a higher limit of Rs. 5,00,000 would be applicable for such contribution, and interest accrued in any previous year in that fund on or after April 1, 2021 would be exempt up to that limit. It may be noted that interest accrued on contribution to such funds up to March 31, 2021 would be exempt without any limit, even if the accrual of income is after that date. Exemption under Section 10 subsection 11, and 10 subsection 12, would be available to an assessee irrespective of the regime under which he pays tax. The CBDT has, vide Rule 9D, notified the manner to calculate taxable interest relating to contribution in a Provident Fund or recognized Provident Fund, exceeding threshold limit. Interest income accrued during the previous year which is not exempt from inclusion in the total income of a person, taxable interest, shall be computed as the interest accrued during the previous year in the taxable contribution account. For this purpose, separate accounts within the Provident Fund account shall be maintained during the previous year 20 to 21, 20 to 22 and all subsequent previous years for taxable contribution and non-taxable contribution made by a person. Non-taxable contribution account aggregate of Point 1. Closing balance in the account as on March 31, 2021. Point 2. Any contribution made by the person in the account during the previous year 2021, 2022 and subsequent previous years, which is not included in the taxable contribution account, and Point 3. Interest accrued on Point 1, and Point 2, as reduced by the withdrawal, if any, from such account. Taxable contribution account. Aggregate of Point 1. Contribution made by the person in the account during the previous year 20 to 21, 20 to 22 and subsequent previous years, which is in excess of the yearly threshold limit, and Point 2. Interest accrued on Point 1. As reduced by the withdrawal, if any, from such account. Yearly threshold limit is Rs. 5,00,000 if the contribution by such person/employee is in a fund in which there is no employer's contribution, and Rs. 2,50,000 in other cases. Where the accumulated balance in RPF becomes taxable, the tax payable in each of the years would be computed as if the fund had been a new RPF, and the difference in tax would be payable by the employee. If, after termination of his employment with one employer, the employee obtains employment under another employer, then, only so much of the accumulated balance in his provident fund account will be exempt, which is transferred to his individual account in a recognized provident fund maintained by the new employer. In such a case, for exemption of payment of accumulated balance by the new employer, the period of service with the former employer shall also be taken into account for computing the period of 5 years continuous service. The payment from recognized provident fund balance is fully exempt from tax in following cases. Condition 1. Employee has rendered continuous service for a period of at least 5 years. Or Condition 2. Where employee could not complete 5 years of service by reason of ill health or discontinuance of the employer's business, or other cause beyond the control of the employee. In any other case, the payment from recognized provident fund is fully taxable in the manner given below. I. Interest on employee's contribution is fully taxable under the head of other sources. 2. Employer's contribution and interest thereon is taxable as salary under Section 17, 3. 1. If employee gets transfer of balance of recognized provident fund with another employer who also maintains recognized provident fund, then the period of service under former employer shall also be included in calculating the period of continuous service. 2. Any payment from fund by way of transfer to the account of the employee under a pension scheme, new pension scheme under Section 80 CCD, shall be exempt. Conversion of unrecognized provident fund into recognized provident fund. When an unrecognized provident fund gets converted into recognized provident fund, then, the income that would have been taxed had the fund been recognized from the date of its institution would be taxed as the income of the employee during the previous year in which the funds get such recognition. The amount not transferred to recognized provident fund and paid out of unrecognized provident fund will be taxable in the same manner as the lump sum payment from unrecognized provident fund is taxed.